How's it going? Tim Barford here with Mortgage Advisors coming at you with a weekly market update. I go through all the news and everything to give you the important information so you don't have to. Everything that impacts housing and mortgages. Quick reminder, this is not spam. This isn't CRM generated. This is me taking the time to put this information together for you. So let's jump right into it. First things first, the big news this week was the Fed hiking rates. Quick reminder, they control the federal funds rate, short-term rates, not a direct correlation with mortgage rates. So they hiked by 75 basis points. That's 0.75%. Their third back-to-back 75 basis point hike. And now the federal funds rate is in between 3 and 3.25%. They want to take this all the way up to 4.4% by the end of the year. That means another 125 basis point hike between the next two Fed meetings, and then take it up a little further in 2023. So their main objective is they want to bring the core PCE, that's the personal consumption expenditure, their favorite measure of inflation. They want to get that back down to 2%. So they're hiking to fight inflation. Hopefully, once inflation comes back down, mortgage rates will follow, and they're likely going to lead us into a recession. Although they don't like to admit it, Jerome Powell, Fed chair, even said himself the chances of a soft landing are likely to diminish as the Fed continues to tighten. So I'm sure you've seen it all over the news that we're heading into a recession. Goldman Sachs is on board estimating that. Fannie Mae says by Q1 next year. And one of the biggest recession indicators is when the 2-year and the 10-year Treasury yields invert, which it happened the first time a couple months ago. A recession normally follows. So one thing to note is this week the inversion was 56 basis points, and that's the biggest since 1982. I also want to touch on a few other recession indicators. 2 consecutive negative GDP quarters. I'll touch more on that in a second. Shortly after oil prices spike, which that happened a couple months ago, following federal fund rate hikes. Unemployment is a lagging indicator. That got all the way down to 3.5%. Now it's up to 3.7%. And the Fed estimates that that's going to hit the 4s in the very near future. So, like I said, the 2 consecutive quarters, that's normally the definition of a recession. I know the White House recently tried to change that, but Q1 was negative 1.6%. Q2 was negative 0.6%. That's not the final number yet because they normally do a couple revisions. So we'll have that final number in the near future. What about Q3? So the Atlanta Fed came out and said, at the end of August, they estimate GDP for the quarter to be 2.6%. Then 10 days ago, they cut it in half to 1.3%. Last week, it was 0.5%. And now they're saying 0.3%. So who knows? Are we going to have a third consecutive negative GDP quarter? Would the White House be on board with a recession at that point? Who knows? But stay tuned because we'll touch on that. So another thing that's interesting is the total estimated GDP for the entire year is going to be 0.2%. So that's not very high. So now let's get into inventory. Builder sentiment continues to decline. So builder sentiment is on a 0 to 100 scale. 50 is the break-even point. Anything above signals expansion. Anything below signals contraction. So the sentiment fell from 49 to 46 in August. The good news for you guys, if you're selling new construction, is that more and more builders are willing to give incentives right now. So more than half of builders are using incentives to bolster sales, mortgage rate buy downs, free amenities, price reductions. So last month, roughly 24% of builders reported reducing home prices, and that's up from 19% the prior month. Builders absolutely cannot have finished products sit for more than 3 months. Another thing, speaking of new construction, housing starts for August. So single family starts were up slightly, but the annualized pace was only 935,000. Single family permits were down, annualized pace just under 900,000. And single family completions were up slightly, but the annualized pace is just over 1 million. This is a major problem because right now, annualized household formations are somewhere between 1.6 to 1.7 million. So this isn't helping our inventory problem. There's just not enough homes for the number of people that need to live in them right now. Now let's switch gears and talk about existing home sales for the month of August. This is the majority of the housing market. Closings on existing homes. So it was down 0.4% month over month, down 20% year over year. So inventory dropped from 1.31 million to 1.28 million. And this is normal at this time of the year. It's seasonal, it's cresting, which happens at every year. So the 1.28 million, that's a 3.2 month supply. But the thing is, a normal market 6 months. But the thing is, 39% of those homes are under contract right now, so you can't go make an offer on them. A normal market is only 25% under contract. So with that being said, active listings, 779,000 homes, that's only a 1.9 month supply. There's just not enough houses, like I said. One thing I want to touch on is appreciation. I know the media is saying there's going to be a huge housing correction, a huge bubble. I just don't see that happening with the supply and demand being so lopsided. But Zillow released their home price forecast for the next 12 months. They revised it down from 2.4% to 1.2%. That's a national average. Some markets might pull back. Here in Florida, I think we're fine in all the major markets. I think we'll probably be 5% or so year over year. Fannie Mae origination volume projection, they estimate that in 2022 we'll be at 2.44 trillion, 2023 2.2 trillion. So although it is a 40% decline from the past 2 years, if you look historically, it's still pretty strong. But we also have to take into consideration that home prices are way up, so it's going to be less number of transactions. Last but not least, I want to touch on mortgage rates. This has been an absolutely brutal week for rates. The bond market's down about 200 basis points. It's probably at least a 3/8 to maybe 0.5% increase in rates. I'd say right now we're looking at high sixes to low sevens, just kind of depending on the number of discount points. So it's been a rough week. Hopefully, once the Fed gets inflation under control, we will see rates start to come back down. We know appreciation is moderating, so just be ready when the rates do come back down. I have a really strong feeling that all the rooted sellers right now with the low rates are going to want to take all that equity and buy the new bigger house that they want or need. So stay tuned for the Facebook Live next week, and then in 2 weeks I will do another update. Thank you.